Well, hedge fund manager David Einhorn is an outspoken critic of the credit rating agencies. In a recent New York Times op-ed, he wrote, "One obvious lesson from the economic crisis is that we should get rid of the official credit ratings that inspire false confidence, aggravating slowdowns and inflating booms." Einhorn is the president of Greenlight Capital, joining us now on the phone. David, great to have you with us.
Great to be here. Good morning.
Good morning. And, I know you were watching the testimonies yesterday with great interest. You said that they were damning. What was most damning about this?
I think there's two basic issues that are kind of confused. One is there's a basic unchallenged view that the ratings are a public good. In fact, I think that the ratings are a public bad. It's very risky to have your business or you're dependent on just like a single customer, like if you sell all your product to Walmart. And it's similarly dangerous to have your credit determined by one or two centralized official committees. When you run into trouble, it's much better to be able to go to the entire market to prove your creditworthiness and to try to borrow money as you need to. And so having this centralized decision making is really a very big problem.
And yet, David, there appear to be this belief among Buffett and others that there really is no alternative to the current system. Is there really an alternative?
Well, it reminds me a lot like when my parents told me when we were 7 that we were moving to Wisconsin, and I didn't know what would happen. Would I make new friends? Would I have a new school? How would this all work out? And I was very upset at the time. But we moved, and it kind of worked out okay. I mean, the idea that if we didn't have ratings, official ratings, something bad would happen, I don't think makes that much sense. It's not like Morgan Stanley and Bank of America are going to say, well, we can't underwrite bonds anymore. And it's not like bond buyers would say, well, we can't buy bonds anymore. Basically, we would just have a new way of going about it. Right now, we do IPOs for stocks. There's no official ratings for the stocks before the IPOs get done. The market would adjust if we didn't have official ratings.
Well, I mean, in your best view, and I like your example of sort of striking it on your own. I mean, if some companies or issuers were to strike it on their own, what would they find, though, David?
Well, right now we still have the system of official ratings. So they're sort of locked into it because everybody does it. So what we really need is sort of a systemic change to just reject the idea of having centralized official ratings, and then the market would adjust, and it would be the same adjustment for everybody, so nobody would have to be striking out on their own.
Okay. Getting back to Buffett, though, David, were you surprised by his reasonings for backing Moody's?
Well, I think it's really very much to his credit. When he identified Moody's a decade ago, look at the competitive position that the company had, and I think he made a fine investment. It did well for a long time. Even with everything that they've done, I think, to sort of ruin their brand, I think he still made a very nice investment for himself. I think from here, the risk-reward in the stock is still pretty negative, and so we're on the other side. But I do understand what his thinking was.
But how much, and I know that you yourself you've made a pretty nice investment so far in shorting Moody's and also McGraw-Hill, which owns S&P. I mean, how much further do you think those stocks have to go down?
Well, I think that they're lousy investments for a few reasons. I think, first of all, that their brands are ruined. And yes, one thing that came clear in the hearing is they basically had the attitude that our market position is so bad that no matter how poorly we perform and how badly we behave, that our market position will be preserved. But I don't really think that that's true. I think that the brands are ruined. I think that Congress is already putting in laws that will make it much harder for them to recover towards their former level of profitability. I think just yesterday, Europe announced that they're going to regulate the rating agencies, basically with a view, I think, to getting rid of the U.S. credit rating oligopoly, at least reflecting European credits.
Right.
And ultimately, these guys face enormous legal liability through a whole variety of lawsuits, where if they ultimately lose even a single one and have to pay off any bondholders, given their capital structures, particularly Moody's, which has a fair amount of debt, equity holders won't do very well.
And David, did you find, and I was going to ask you about that European model, but did you find, though, that what the Moody's executives and former executives were saying was going on at the company, did you find that also is happening at Fitch and at S&P? this whole idea of understaffing and the pricing problems.
Right. Well, when you look at the margins that the credit ratings had during the boom, it was pretty clear that they were charging a lot of money and not doing very much work. And there's a lot of evidence that these guys were very focused on their market share, and they allowed their quest for market share and for profits to compromise their ratings objectivity. And that's what for example, some of the legal challenges are about.
But short of what you're proposing, David, which is essentially to phase these guys out from the system. I mean, if we were to, for instance, raise the amount of staff at these companies, if we were to change the pricing model, wouldn't that in some ways be the answer to this?
No, because the problem isn't just having better ratings. That's what they want you to discuss. Can we have better ratings? But ratings are, by definition, impossible to measure. Credit analysis is a probabilistic thing, right? And if I told you, that there's, a 50% chance that you're going to get red the next time you play roulette, and then it turns out that it was black, I didn't give you bad advice. The percentages were what they were, and the future is uncertain. So you can't measure credit ratings based upon what subsequently happens, given all the uncertainty that's out there. What we need instead of better ratings is we need to get rid of having official ratings so that the market can judge risks for itself. And the people, incidentally, I should add, the people who say that they don't use the ratings, they actually use them a lot.
Right.
They use them to identify misrated securities. They engage in all kinds of rating arbitrage where they're basically front.
Okay. David, let me just have you hold that thought because I'm going to get back with you right after this break. We'll be back on In the Loop. David, if I can just take this example of BP, some might look at the actions this morning from Fitch and Moody's as a sign that perhaps agencies are starting to get back on the ball with ratings. You, however, may argue that this is just an example of them being behind the ball?
I don't think it's a particularly relevant example. You have a significant event with BP, and the rating agencies are managed to change the credit rating by an entire half notch or something like this. Mm-hmm. It's almost humorous if you think about it. Okay.
All right. Well, let's get back then to the larger issue about the rating agencies. I know that you've talked about, essentially that the model is broken in some ways and that these brands are ruined. But David, in your view then, does that mean that every issue out there right now is misrated by these agencies?
No, I don't know how you would come to a conclusion, like that. But the bottom line really is the rating agencies, they don't really do very much work. But even if they did work, and even if they did sort of figure out their ratings, because of the probabilistic nature of it, I mean, I'm not sure that they add that much value. Market spreads are a much better predictor of future default or future risk. So people who need or think that they need measures of that, I mean, they can just look at the market spreads, and that would probably give them better risk management tools.
But for others who argue, though, for the survival or the continuation of these agencies, they say, look, they do serve a purpose. Our guest yesterday, Jim Reynolds, did note he's been critical of agencies, but he did say, though, that they serve a purpose for those who don't have the resources to evaluate risk themselves. That they do have to rely on these agencies. They do the legwork for them. I mean, what would you say to that?
Well, I think that's the kind of comment that seems to come from all the people who say that they don't use rating agencies themselves. And I think the truth is those people who say they don't use rating agencies actually love the rating system because they try to identify misrated securities. They assume that the rating agencies are probably wrong. They front-run what they think the rating agencies are going to do. They take advantage of people when rating agencies downgrade things that they think are then going to behave mechanicalistically, and so they figure out how to buy from forced sellers at artificially depressed prices as a result of rating agency actions. So basically what's happening is there's some passive money that is tied to the use of ratings that basically gets their pockets picked every day by the guys that understand how the system works. And they would actually be better served themselves if they abandoned their own use of the rating system and if we abandoned the use of credit ratings. They would be much better served to use, for example, market spreads.
Okay. All right, David. It was great to talk with you. Thanks so much for taking that time with us. David Einhorn, the president of hedge fund Greenlight Capital, talking about the rating agencies.